Condors are the ultimate trading strategy to make a fortune. In this video, I'm going to explain why this is such a goldmine of an opportunity and how you can exactly make weekly and monthly income and grow your small portfolio very quickly using my specific Iron Condor strategy with my setup, how I open, close, manage, and everything else in between. Specifically, we really do need to discuss how we're going to take advantage of Delta, which best stocks I recommend for the Iron Condor strategy. And basically, this is going to be a masterclass on Iron Condors. So make sure that you stick out throughout the whole video. And basically, the reason why I got inspired to talk about Iron Condors today is because one of my clients, Chase, ended up reaching out to me and he showed me his portfolio. And he ended up making 27.88% in one single month using the Iron Condor strategy, and he's growing his small account right now. I'm very proud of him, and when he reached out, I was actually pretty curious myself because I know he's following some of my trades, but also I'm very proud because I've taught him how to fish for himself. So he's doing a lot of trades on Microsoft, Adobe, Apple, Qualcomm, Netflix. So I'm going to go over some of these trades with you so you can see exactly how much money you can make. Let's start off by using Adobe. Adobe is something that I recently opened up in my Discord channel. Every single time I open or close or buy or sell something, my Discord knows about it right away. So let me go through my portfolio right now and check out my Adobe trade. So far, I'm actually down, and I just opened this up yesterday. And that's not a bad thing. I may actually end up doubling down on this position live in this video right here. And as you guys can see, I'm actually doing really well so far this year, up about 93K, despite obviously I do make mistakes from time to time. But anyways, I want to go into Adobe right now. I'm going to open up this trade, and I'm currently down. So I want to open up this same position from scratch. I'm actually going to place this trade because I really like this trade. Okay, the strikes that I'm going to pick is going to be 310, 315, 385, and 390. Don't worry, I'm going to take my time and explain why I'm going to do that right now. Let's first just look at the chart of Adobe, okay? On the 1 year chart, this stock has sold off a lot, and now it's steadily rising and has some decent momentum. But if you look at the 1 month, although this stock is up 7%, this is still a very good candidate for an Iron Condor. Specifically, an Iron Condor is a very good strategy that you should use when a stock is pretty range bound. Now, although Adobe is 7% up, on the 3-month chart, it's actually only up about 12%, which is a good gain, but I'm going to show you how you can use an Iron Condor to still make money, whether this stock again goes up 12% or even if it goes down 12%. An Iron Condor takes advantage of volatility. And in just a few short minutes, I'm going to show you what implied volatility is and why it's so important for this strategy. I mean, I truly believe that Iron Condors are a way to build a small fortune on a very consistent basis. If you have a small account, honestly, Iron Condors are the #1 strategy because it really is like a gold mine because you're selling both puts and calls, so you're basically collecting double the income. So if you're an income trader like me, this is definitely the best strategy. So I'm going to go into trade Adobe options. And real quick before I click this, you'll see that the top is basically 364 and the bottom is 285. The bottom is pretty steep, but for me, this was really an overreaction. So I'm going to go ahead and open up a very similar position to this, which is 315 and 385. So I'm going to go into Adobe options. I'm going to sell a put just to get started, okay? This is how you start off with an Iron Condor. I'm going to pick an expiration date. And again, we saw for the past 1 month, the stock is up about 7%. So again, and even if you're watching this in the future, I'm just gonna go out 1 month. If this is in the future for you, just go out about 30 days. So for me, it's currently January 25th. Let's just go out till, you know what? Actually, I'm gonna go out until March 17th. There's nothing wrong with 6-week options, okay? But 4 to 6 weeks, perfectly fine. So I'm gonna go to March 17, and that's about 6 weeks out. I'm going to go down. I'm going to pick a strike price. And there's a few things I'm going to look at. Let me first go a little bit lower than 315. I'm going to go down to 310. The reason why is I just want to be a little bit safer. The delta right now is 0.14. That's fantastic. It's lower than 15. That means about 14% of the time I'm going to have some trouble. But again, I'm going to show you how to manage this position. So looking at the implied volatility, the higher this is, the better when you're selling Iron Condors. And the lower this is, the better if you're buying Iron Condors. For me, I'm an income trader, which means that I'm just looking to sell options, okay? The current volume is 50, That's good. The open interest is very high. That's fantastic. And looking at the bid and ask spread, I'm actually very happy because one option that I always try to trade is Chipotle, but I can't because the bid will be out of whack. I mean, completely out of whack. It'll be like 435 and then the ask will be like 625. And that's really bad. That's a very illiquid and bad market. But for Adobe, the bid and ask is very tight. So that is a fantastic thing. That means there's very little slippage. Little slippage means that I'm not going to be wasting money trading this option, okay? So I'm going to go to sell put right now. That's how you get started with an iron condor. That's how you open it up, okay? I'm going to go sell, and then I'm going to buy another put lower than my current sell. So looking at my current sell, it's 310, and that's going to be dangerous because that's going to be a lot of collateral, and this video is all about growing a smaller account using iron condors. So the way that you negate this and not have to put up so much collateral is you end up buying a put lower than your current strike price. Now notice, the premium here is 435 and I'm going for 380. So I'm gonna be buying a 380 right here. So I'm collecting more than I'm paying right here. So when I end up clicking this option right here, you'll see that so far I'm off to a really good start. The maximum profit is 68 and the maximum loss is 432. Very, very good so far, okay? But it gets better than this, okay? Because this is just a put credit spread right here. Now I'm going to do a call credit spread. And it's important for me to open a proper strike price. So for me, that means I want to go out of the money enough. And I think the top here was around 375. So let me go higher than that, okay? In fact, I can go a lot higher because as I look at the premium here, it's very good. It's very high. So I have no problem even going up to 390. The delta is very high here. The implied volatility is not as much as I would like. And that's probably because Adobe is already up a lot. So traders are not buying as much call options and there's less volatility on the call options because there's a less likelihood of the stock rising since it's already up a good amount. But still, I want to be safe. I'm going to go up to 395 because I do want my delta not to be too high. And look, this is kind of a feelings game. There's a lot of math involved, but also I don't want to go too high. Adobe is already pretty high in terms of its 52 weeks. Adobe is already high in terms of its 3-month chart. So for me, I don't need to go too low on the delta. I'm actually fine taking a little bit slightly higher risk here with 24 delta. That's more than fine. So I'm going to go ahead, sell the 395 right now, okay? And then again, I'm going to go buy the next leg higher, okay? So the first leg is 395, selling that, and the next leg higher to protect myself from a very bad adverse move. So as you can see right now on the chart, a bad adverse move is if the stock were to move up, well, I'm uncovered here. I have a naked call option. That's very bad for risk management. And that's very bad for my overall risk profile. And if I lose once, it's going to be a huge loss. And I can't be a consistent income trader if that happens. So instead, I'm going to go ahead and buy a $400 call option right now. And there you go. Before, we were getting about $68 and we were risking roughly $432. Now, things are looking gorgeous. I mean, this is a way to make a lot of money. Look, it's 173. I mean, check it out. Just take a look at it. It's 173. Would you look at that? Okay, so 327 is the risk and 173 is the max profit. Now that's a very good risk to return profile. I'm getting 50% return here in just 6 weeks. 50% in 6 weeks is a phenomenal return. In fact, if I were to do this consistently, every even 8 weeks, that's going to be, 6 times at least in a year, 6 times 50%, that's 3xing a portfolio. In fact, even more if you factor in compounding. But hey, that's a large return, and this is how I would basically manage, okay? We need to discuss managing this position because it's cool to open up this position, you make a lot of money, but here's the risk, okay? If the stock ends up going towards this area around 395, which is your strike right here, you're going to start entering a danger zone because anything above 395, you're quickly getting out of the profit zone into your risk zone right here where you can lose money. In fact, your break even is 396.75. And that's because you're collecting $175 here. So you can add that on top of 395 to get 396.75 right there, okay? So you don't want the stock to go higher than 396.75. Now listen, you don't also have to use Adobe. You can use any stock. You want to find a stock that you think is range bound and then copy and paste my logic and my ideas here with this iron condor. If a stock is moving basically sideways, you should use an iron condor strategy, because an iron condor strategy will profit from when a stock stands pretty still. So as long as the stock is in between this green area profit zone, your iron condor is going to be profitable, especially if it stays exactly in the middle. Then you're really going to quickly see the profits roll in. You can actually close this position early. So for example, say that you open up this position and then in a week the stock is still basically standing where it is. Well, this position is going to have a big increase in value. So you're making 173 and you might actually be able to realize, say, like a $50 or a $60 gain here. So you might actually be able to realize about a 33% gain in just 1 week if the stock ends up standing still. Now look, a very common question is if the stock ends up pulling back, let's say it pulls back a lot, but it's still in the green area. In the meantime, you will actually see a loss on your position. The position will show you a loss, and that is because there is an increased risk, and it is actually much more likely that the stock may close in this area, and option traders in the market are factoring that in. So it's factored in because you're getting closer to one of your break evens. But what you should do is absolutely nothing. Just because you're getting closer to your break even doesn't necessarily mean that you have to close your position as a whole. In fact, what I often see is a stock will bounce around and it'll actually have violent bounces back and forth. So one day you might see a negative 3 or 4% decline in the stock market on a big day. Then yes, your iron condor will look like it's losing money, but then the next day it will swing right back. And I made so much money by being patient and not really closing my position, just waiting, especially waiting on those last few days where theta, and let me be specific, theta is the time decay of options. And it really kicks in on those last few days. So as this option approaches its expiration, so for here, March 17, in those last few days, it might get a little hard because the stock might be close to the break even. But as long as it's in the green profit area, I'm going to keep holding it. That theta will really kick in and start making me a lot of money, especially in that last week and especially in those last few days. Now, question, if the stock actually goes into the red zone, what you should do, okay? And that really depends on where the technicals of the stock are. If the momentum is continuing to go higher every single day, and it looks like that stock is going to keep going in that direction, then you may want to take what you can get and basically just close this position out. In this scenario, you can lose up to $330. But if the stock continues to go up and it's really in this red zone and it stays there for a while, and you can see the stock only moving in this continued direction, then you may want to close that position. And in fact, if you can close this position for just 160 loss, that's fantastic, because half of 330 is 165. If you can actually mentally commit to cutting this position when it does reach a 50% loss, then that's fantastic, because you're collecting 170 and you're only risking about 165. And that's typically how I like to enter my trades. Here, my chances of winning are actually very high. Look, even my call credit spread, the call side of this iron condor, is 24%. But if my risk to return here is about 1-to-1, like I said, if I cut at 165 and I'm making 175, then I'm basically collecting 1-for-1 risk, okay, risk to return, but my odds of winning are actually about 76% chance. So there's a discrepancy there. I'm going to be winning 76% of the time, and I have a 1-to-1 ratio. So you tell me what happens. 76% of the time, I'm going to be way ahead.